Welcome to the section on adjustments of single options. So what exactly is an adjustment? And to understand adjustments, you have to first look at what you can do with a stock. Let's say you buy a stock and you're expecting the value to go up, the price of the stock to go up. But if the price of the stock goes down, what is it that you can do with your stock? You can probably double up, do some cost averaging, or you can sell your stock, or you can hang on to the stock, but you're going to see paper losses accumulate in your account. So there's really nothing you can do to adjust your stock position except for perhaps doubling down. And of course, you can sell your stock, and all you'll be doing is booking your losses. So stocks are very inflexible in that sense. But in options, that's not the case. If you buy an option or you buy a spread or you sell an option or you sell a spread and the position starts going against you, then you do have various alternatives, and that's why they're called options. You have various options that you can add to your position that will act as an adjustment to your original position. So adjustments are key in options. It's a part of options trading, and we've mentioned this before. It is the third leg of the stool in options trading. So you have to become a master in adjustments, and you need to know how to adjust single options, and you need to know how to adjust spreads. Because once you learn how to adjust single options, you can always adjust a spread. And once you know how to adjust spreads, you can adjust all the advanced strategies, like the four-legged strategies, the iron condor, and even the straddle and the strangle and things like that. So we have to adjust for two reasons. One is if the stock is going against you, then you have to adjust. And two, if the stock is going in your favor. So we saw that in the FXC trade earlier in this course. We did quite a bit of adjustments. We obviously, when the stock is going in your favor, the adjustments are more simpler. All you need to do is you cut down your size. So if you had 20 contracts, you can bring it down to 15. You can bring it down to 10. But then there is also another kind of adjustment that you could have done to the FXC trade, which I didn't want to make it too complex. So, I didn't show you that because it was too complex for that course. But now you're going to have to get into these kinds of issues because as you move forward in the courseware, you're going to get a little bit more advanced in all of these tactics. So adjusting a profitable position is fairly simple. Where adjustments really become a lot more tougher is when you want to adjust a losing position, and that's really the key to options trading. Because nobody can be perfect. Even the professional investment money managers, they're not perfect. They can't tell you exactly how their trade is going to play out, and therefore you need to have this particular strength, which is the art of adjustments. So when you adjust a losing position, let's say we bought a call. So let's take an example. And in the following two lectures, we're going to see some exact details. So let's say we bought this 500 call. And if we bought that, we will have 10 contracts of the 500 call. We're going to pay $2.64 for this particular option. If you look at this risk profile, it's a long call. We've looked at this before also. And we have a max loss of 2,640 for anything less than 500 if Apple expires less than 500. If Apple goes up, then you have a profit. So in which case you can cut down your size. You can perhaps sell a call at a higher strike price. You can do a couple of different things there. Now, if Apple starts to go down, then you'll see that you're going to see some losses accumulate in your account. So if you had this long call, what is it that you can do? Let's say you bought this option when Apple was at 460, but then after you bought it, let's say in a few days, Apple starts to go down and it's approaching 440 at this point. So it's gone down $20 from where you originally put your trade on. So at this point, you have to decide what is your outlook for the trade. Has your outlook changed? Because Apple's gone down $20. So obviously you were wrong when you put the long call trade on. So if your outlook has changed, then you have to change your trade itself. So this is a long call and you'll have to change the trade. You'll have to make an adjustment to this trade so that it reflects your new outlook. Because whenever you have a long call, bear in mind you have a positive delta. And of course, you have all these other Greeks also. But the one Greek that's going to hurt you if a position goes against you, it is delta. So delta is the real key to understanding adjustments. So at this point, for every $1 that Apple goes down, your position is going to go down by $151 because you had a positive delta, which means your position needed Apple to go up. And for every $1 it went up, your position would have gained by 151. But because Apple is going down, for every $1, you're going to lose $151. So therefore, your key adjustment Greek is going to be the delta, and you have to look at delta and see how you can adjust it. Now, there's a couple of different ways you can do. If your outlook is changed, then this delta number should become a negative delta, because then you're optimizing a bearish sentiment in the stock. But if your outlook has not changed, then you would want to neutralize this delta, which means you bring this delta to a delta neutral position. So those are a couple of thoughts that you need to think about when you think of adjustments. In the case of options, you have several ways you can adjust your position. So example, let's just take this. And if we wanted to get a delta neutral position, perhaps we could sell a call option at maybe the 490 or the 495. Because if you sell a call option, that produces a negative delta. Because selling a call option is, in general, a bearish move. So if you sell a call option, you'll get some negative deltas. You'll have to look at what strike prices give you the right kind of delta that you want. You could also buy a put option. When you buy a put option, you'll also get negative delta. So once if you think Apple is going to go down and it's continuing to go down, you can perhaps buy a put option at the 460 strike price, at the 470 strike price, at the 440 strike price. And what you'll need to do is look at the number of contracts, simulate your trade, and create either a delta neutral position or a negative delta position itself. So that's just the philosophy of adjusting. And over the next two lectures, we're going to see some details on how you can do this. I do want to point out that if you want to adjust, make sure you don't over adjust. So whatever adjustment you do should not create a drastically different position that you did not intend it to be. So for example, if we have a 151 deltas, positive deltas, you shouldn't create an adjustment that creates a negative 200 or negative 300 delta. Unless, of course, you were convinced that Apple direction has changed, the outlook has changed, and therefore you need to drastically change the deltas. But in general, if you do drastic adjustments, you will find that Apple will suddenly stop and it'll try to come back, and there'll be a lot of choppiness there, and you'll find that you're continuing to adjust your position. So you don't want to fall into the trap of over adjusting, and that's my point with that particular point. So you don't want to over adjust. You want to look at your outlook, and based upon that, you want to choose a particular delta for your adjustment. In the next two lectures, we are going to see some specific examples of how you can adjust your single option trades.